T.Mayne, your FX Chasers mentor, back again with another value-packed video just for you. Now, in today's video, guys, we're going to be getting into understanding the concept of liquidity. Now, this concept, guys, functions in any market, like we speak about, any financial market, and that's the point of the series, so that you can become more efficient in any instrument that you're trading. Now, before we actually get into the meat of this video, guys, the comment section is yours. Let me know if you want to go into any ideas, any new topics, any of that stuff, whatever you're brainstorming, let me know in the comment section. Otherwise, guys, leave your like for the end of the video. Watch until the end. Make sure you get the value that this video is intended to provide, and then give this video a big thumbs up. Now, guys, let's get straight into the whole concept of liquidity. Now, what is liquidity to begin with? Liquidity is basically, fundamentally, the ability to execute orders. Now, the ability to execute orders whenever you want to execute orders, and the ability to execute orders of any size. Now, that's what I want to place an emphasis on, of any size. Now, remember, guys, we are trading in the financial markets. There's different types of market participants. There are market participants like us, like me, retailers, obviously, that don't have a lot of capital. So for us, liquidity is not really a problem. Whenever we go on Euro USD, we click buy, we click sell, that order gets executed immediately. Now, obviously, like I was saying, there's a lot of different market participants. There are other market participants that have an excess of funds or a large amount of funds that when they press buy or when they press sell, in most cases or in some cases, there's often not enough market participants to absorb the other end of their transaction. Because remember, guys, we're speaking about financial markets. In financial markets, there are only two real participants, buyers and sellers. And markets want to be as, and I need to write this down, markets want to be as efficient as possible. How do markets try and be efficient? Markets will always try and balance out the amount of buyers versus the amount of sellers. Now, also, going back to our concept of liquidity, the ability to execute our orders, we need to have other people on the opposite end to absorb the trade. Like, for example, if I wanted to buy something, me, T.Mayne, this dude over here, wants to be a buyer. Who is this guy buying from? This guy doesn't just buy from thin air. There needs to be, let's even use a different color. There needs to be you on the other end. There needs to be you on the other end that is going to sell me what I want to buy. Now, obviously, inverse also is true. If you wanted to sell something, who would you sell to? You would need to sell to another buyer. Hence, the whole concept of efficiency. Markets want to be efficient and match buyers and sellers. Now, getting into the actual meat of what we want to speak about, this whole concept of liquidity. It's so exciting, guys. I absolutely love this concept. Now, liquidity. Remember, I told you about the market participants that have an excess of funds. Now, they can't always execute orders when they want to. Now comes in the concept of generating liquidity. How is liquidity generated? Guys, we are traders. We understand that markets basically move, let's just use this. Markets move obviously in waves. So we have highs, we have lows, we have whatever the case is. Every swing high has liquidity resting above it. Every swing low has liquidity resting below. Every swing high has liquidity resting above. Every swing low has liquidity resting below. Now, what market makers or what institutions or what these larger players, larger market participants do in cases where they are not able, remember, liquidity is the ability to execute orders whenever you want to of any size. Now, occasionally, when there is not enough market participants to absorb the other end, These market participants generate liquidity. They generate the ability to be able to buy and sell the amount that they want to buy and sell. Remember, I told you above every swing high lies liquidity, below every swing low lies liquidity. How do market participants generate this liquidity? Have you guys ever seen something like this? Yeah, double top structure. We know as retail traders, we're going to be getting involved either the risk entry up top, or we'll wait for the break and the retest, try and get involved in the reduced risk entry. But what happens sometimes? Sometimes this double top can turn into a triple top. What's happening? The triple top, there's first of all the sellers that were involved in this move to the downside, their stops are above here. There's also breakout traders that are looking maybe to trade the breakout if prices break to the upside, because remember, some people are looking at this as a potential uptrending market. Let's actually just draw the whole thing. Let's draw a whole structure, guys. We'll start from the trend itself. We have a market that is trending to the upside. We know there's buyers involved here. There's some sellers involved here. All of the sellers that got in early, what happened to them? Their stop losses were taken out, prices moved higher. We have more buyers involved at these areas over here. We have more sellers involved here. Their stops got taken out as well. Now we have, let's start to draw in this potential double top structure. Now we have some intro or introduction of some sellers jumping in at the top here. Where are their stop losses? Their stop losses are above here. What happens? Because banks, let's just say in this case, banks want to sell, or large market participants want to sell. What do they need to do to be able to sell this market with the liquidity that they need to execute their orders? They're going to look for an area where both buyers and sellers are exchanging value. Remember, there's people that sold, their stop losses are above here. There's also people that are looking to trade a breakout of these levels of structure to the upside. So there's a lot of liquidity. Remember, above every swing high, below every swing low, there lies liquidity. Now enter the creation of the double top. Now this double top sometimes comes up, pokes above these areas, grabs all of the liquidity that was here. Obviously banks and whoever else uses this liquidity to then execute their sell orders. Now, remember the first example I told you, after we see that double top, we're in, we're happy. Then this double top now turns into something else. This double top turns into a triple top. So now we have even more liquidity. Remember all of the sellers that were involved here, maybe some of them had their stops higher, maybe some of them re-entered after they were stopped out. Now we know that there's more stop losses above these areas. There's more breakout traders looking to trade above those areas. What happens also here? There's some stops below for some buyers that were involved in this market thinking that the trend is still going up. We come, we grab this liquidity below. Market participants obviously enter their orders, their massive orders. Then prices move to the upside, grab liquidity one more time just to turn into a head and shoulder structure and make that move to the downside. So in a way, going over this concept of liquidity, I'm explaining to you guys, first of all, how you should be looking at the market, to spot entries to enter, to understand what smart money is doing. And I'm also explaining to you, I'm going over a concept that can make you understand that sometimes you can be right on the direction, but wrong on your entry time. And yes guys, it's okay to take those 1 stop, 2 stop losses, 3 stop losses, and still re-enter, because most of the time, more often than not, you're right in the direction, but you're wrong on the entry time. Now, this market obviously gave one entry to be a seller, took you out, another entry to be a seller, took you out. Maybe you're in on the 3rd time, and the 3rd time you might just get it right. Prices will always give you those pullbacks to enter again, whatever the case is. Now, why do the markets impulse to the downside after we see this nice uptrending market followed by this nice distribution area where obviously sells were being added on in this area over here? Why do we see another impulsive move to the downside? Obviously because of the liquidity, guys. All the buyers, where their stop losses? Below here. All these buyers that were involved here, their stops are below here. All these buyers that were involved here, their stops are below here. Markets want to be efficient. So once, remember the previous video we spoke about supply and demand? So once there is excess of supply in this market, obviously sellers in this market, now prices rush to the downside, stopping all these other traders out. Along the way, remember within this phase, banks have been selling, banks have been selling, banks have been selling, banks have been selling, and getting you out. Every time they got you out, they sold. They got you out, they sold. They came back up, making all of these buyers jump in, and they sold. And now they take those buyers out, they take these buyers out, take these buyers out as well, generating liquidity and moving the markets. Now remember, once that balance has shifted, once there's more supply than demand, then obviously prices move lower. Hence we see this impulsive phase to the downside. So guys, this is just a general video. Obviously, like I told you guys, this is a series and we're building up. We need to set a foundation first before we even get onto the charts and actually explain how we trade using this information. We need to build that foundation first. Now guys, I hope that this foundation was actually solid enough for you guys. Built a nice foundation, something that we can work off in the future. Obviously, we're going to have a lot more videos, a lot more interaction. This is supposed to be us learning from each other, us helping each other understand the markets a little bit better than we did before. So anyway guys, this is the time in the video where I would love to see you hit that like button. Give me a big thumbs up if you actually enjoyed the video, if you found some value, if you gained something. It just has to be one thing. You just need to gain one thing. If you've gained that one thing, give this video a thumbs up. This is T.Mayne, your FX Chasers mentor, and I'll see you guys in the next video.